We have Mr. Wyckoff here, Bruce Fraser. Haven't talked to Bruce in probably almost a half a year. Bruce, it's really nice to have you back, buddy. Missed you. I'm unmuting you now. There you go.
Yeah, it's great to be here. So
Yeah. How
this
have
is
you
one of my
been?
favorite things to do to hang with you guys.
Oh, thanks, Bruce. Has everything been going okay?
We're getting along here.
Yeah.
So
And older?
yeah, and older. Yeah. Well, it's funny because uh, I went back and looked at our old slide decks,
Yeah.
and so I went through and was looking at the old slide decks, and some of the stuff we've talked about in the past, and it's really just uh, way interesting. As a matter of fact, it kind of encouraged me to come back and just do golden oldies and do
Oh,
some golden
okay.
oldies and bring them up to date, because it's kind of a interesting moment for at least my work and in the markets. And now me, I'm more of a stock guy and a bond guy and a gold guy and stuff like that. So
Yeah.
everybody will have to kind of bear with me there. But
Is this a new affiliate, a new business or renaming of the old power charting, or was
oh
that
yeah,
always there?
you know what this is? This is my show that I did for
Oh,
years and years at stockcharts.com.
okay.
And so that was the name of the show. And those shows are still out there, by the way. They're in stock charts on their YouTube channel.
Okay.
And you can go back and look at those. They're very Wyckoff oriented, so that might be of interest. But
Okay.
but anyway, the disclaimer is just as valid.
Okay. We know that.
Yeah.
So sometimes I think about the disclaimer, and I think it should be reversed. That past performance is indicative of future results.
Yeah,
Because if
absolutely.
because if your past performance is terrible, it most likely your future results probably will be terrible. But
You know,
if your current results are pretty good, you know, it might be indicative that you know what you're doing, and that that they may be indicative of future results.
40 years ago, when I was at Dean Witter, as were you, I was, my business was basically as a talent scout. I would find very talented, large money managers that had been in business for a very long time that I could recommend that matched their abilities, match my clients' needs. And so what I do is I make a marriage between a good manager and a client with a need like that. And I did that for a number of years. And so that was exactly what you're talking about,
Yeah,
is finding people that had, because if you had a good track record in the past and you stayed true to your methodology, you were going to most likely have a really good track record in the future, which is
yeah,
all we care about.
yeah.
So
Also, you know what I would look at? Biggest drawdowns when I was looking at money managers, and
absolutely. And
what happened afterwards, because some people just lose it after that, and you know, they can't get back on track.
well, let me ask you something. This is such a good point. I had this conversation the other day. And by the way, if anybody's interested in Wyckoff, my teaching partner at Golden Gate University has a website, and there's a lot of good content. He teaches classes, charges something for those. It's well worth it if you have a Wyckoff interest, but there's a lot of free content there too. So
Oh,
check it
thanks,
out. And then
Bruce.
every week we do a Wyckoff market discussion, and on Wednesday afternoon. So
So is it actually a college course that he teaches Wyckoff at Gold Gate
we for
University?
for 30 years, I taught graduate courses at Golden Gate University in San Francisco in technical market analysis. And
Wow.
And we had a staff of great teachers. Roman was among them, and Hank Prudence started the program, and then he hired me in '88, and it was the only program of its kind in the known universe. And we're back at it now. It had gone dormant for a while, and the program is back running again. You can actually get a graduate degree in technical market analysis at an accredited university at Golden Gate University in San Francisco.
That's really
And
so. Now there's a degree that has some practicality.
right. And I did a
Yeah,
class. My favorite class was on peak performance trading. And we would talk about methodologies, and we would talk about how to create rules, how to
yeah,
execute on your rules, all the things you all talk about here, and absolutely essential to success. And the thing I was going to ask you is such a good point is I think this business is a lot about survivor bias and being able to it's not all going to be just clear sailing. There's going to be
no,
times in the market that are going to be very difficult, and being able to with your methodologies and with your skill sets, and I'm speaking for all of us, you can get out there and make returns when times are good, and keep yourself whole when times aren't good. There's a survivorship bias to that, and that's what allows you to be in this business for a really long time. And believe me, I've coached a lot of people, professionals and amateurs in the marketplace on how to do this. And so I've seen so many people go away, but I've also seen a number of people, survive and succeed. So I'd be
yeah.
very curious about what you think about this.
Well, I think that's the first lesson in trading is learning how to survive by
There you
just
go.
being in
Yeah.
there and not blowing up accounts. You could have drawdowns. I mean, they could be
Oh,
pretty
can't
good too, like
can't not
50%.
have them. Yeah.
So I mean, even if you have a 50% drawdown, you're still have learned how to survive because you're still in the game. My mantra is the difference between pros and amateurs are pros know how to lose, so they have money left to be right with. So as long as you have some ammunition, maybe your first few years in the business, you're down pretty good, but you're not out. Okay, so that's my view on it. It's the most important thing to learn.
Words to live by for sure. And
So so here are all your grandfathers.
that's and there's exactly. And this is what I love about it, and your show is such a good example of that, is you can extend mentorship to the to a platform like this, which is exceptional. But Hank Pruden was, I think he's really the person that kept Wyckoff Method vital back in the 60s and 70s. And then we taught it at GGU. I had the great good fortune of teaching with him the Wyckoff Method. I think it was for 27 years. We taught it at
Yeah.
Golden Gate together for the most part.
Wow.
But
Well,
he was my mentor, and just a brilliant teacher, incredible human. We lost him in 2017, but go out and find mentors, because I had mentors for a number of different aspects of my career and life, and they're just invaluable.
they
So,
are. And
yeah,
be one. And be one.
and be one. Absolutely.
Eventually be one. And kind of like pay it forward. And it's a legacy for you in the industry. The more people that you launch, and I've launched people that are better at what I do than me.
Oh, I have too. Yeah, absolutely. And there's nothing that makes me more excited actually than to have somebody that I worked with go out and just succeed and excel, and to do it at a very, very high level. And I've had that great fortune. And there's just, me, I'm in my little space. I'm retired now, so I just do my thing. And, but I see these people out there just, really doing a great job for themselves and for their clients.
Yeah, and it also opens up a whole new network of people that you could borrow money from when you're in trouble. Anyway, better than the shadow banking system. Anyway, so that's a trader's, huh?
I love it.
All right, so
you always pick the best, most interesting times to have me on, at least for my work. And so I have just a couple things to show, and we have till the top of the hour, right?
Yeah.
Yeah, good. So this is just a life cycle model for the business cycle, and Wyckoff was a big fan of that. And what you're going to see is these Wyckoff structures, and there's a number of different ways these can manifest. I'm going to show you an example of that. That's a real life example that Dale and I have talked about here on a number of occasions as it was unfolding, because as we know, the market's always an unfolding picture. So I just wanted to show this. I know it's fuzzy, but it's so brilliant. And Ramon did this when he was a student, and now he teaches it, and he's so good at it. But let's see. Let me see if I can get my my machine to go forward here. Okay, so here, and I also just want to point out that you can go back and read my blogs, which are all pretty much on Wyckoff, which are at stockcharts.com. They are not behind a paywall. And so some of the things I talk about here, I'll reference them as a, as a blog that I wrote. And this gives you some of the foundational tools and knowledge of Wyckoff. So these are distribution schematics. You'll see some examples of both here. And this is a very important one, reaccumulation. This is a reaccumulation trading range. And you see that they start just like distribution starts, but then the character of them changes as they go towards their conclusion and then start a new uptrend.
That was gold this year, Bruce. We had that big move, and then we moved sideways for, I don't know, 6 months, 7 months before we broke out over 32, 3,300, and then went parabolic. But you had the same type of formation there.
Well, I do have a couple of slides I can show. We've talked about that structure right here. You and I have from a couple different perspectives. So here's an example of a reaccumulation.
Yeah, that's what I'm talking about.
Yeah, exactly. So I use point and figure charts, which is totally old school Wyckoff. Yeah. And this is a reaccumulation structure, as we just showed. Climaxes up into a pausing action and then spends time. And we say you have to build a cause before you can have an effect. And so here you can see the gold miners is characterized by the GDX. And then you can count this and estimate how far up it can go. And in this case, you can see that there's still room to go. As a matter of fact, I can't quite make out the price here. I apologize. So it's 83, 84 right here. Yeah. And it still can go just in this construct. This little one here, it's a small segment. The green one goes 90 to 94. And then the big one goes 162 to 175. So there's still fuel in the tank, we like to say, for higher prices. Yeah. And does it mean it has to get there? No, it doesn't. But it does show here that we have a climax automatic reaction. And this climax automatic reaction sets up a range-bound condition where we may build a new cause for another move. And so let's we'll keep an eye on that. And so it really kind of says that we gotta be patient and let these markets unfold as they will. And then here's silver. You can see it got up to 54, And the count that I had going back to 24 counted right up to where it went, which is 52 to 57. And that's the segment right here. There we are. But we still have higher prices. And if you go look to the right, so this is just trading. So you'll note here reaccumulation, upward stride, goes into a range bound condition, builds a new cause. We can count that. Sure enough, it went right there. So fantastic trade because it came out at around $32. And then up it goes. And we've just gone into the count objective range of this. But if we build a new reaccumulation causal count here, it could have the potential of going even higher. And then this is the one that's really interesting. This is the reaccumulation of silver spot price going from 25 back to 2020. And this count here, which once it came off its lows in 2020, it had an initial markup and then built a bigger cause. And this count here goes up 99 to 110. And as you just saw, silver just touched 54. And this red arrow shows where it was as of when I made this, published up this chart, October 17th.
Oh, I thought it might be implying more zeros to the downside.
No, the zero. Yeah, so I'm glad you brought that up because this is where it's gone to so far. So it looks like it's another climax and automatic reaction that may spend a little bit of time in here. And we'll watch how that unfolds because that'll tell us what, what could happen next.
Yeah, a lot of technical guys hoping for 42 to get long again.
Okay, well, I would buy that completely, absolutely. Yeah. So here, now this is kind of the part that I find sort of compelling right now, timely, and Dale always does that to me, has me come in when
turning points. Yeah.
So this is now this is a very messy chart. This is actually not a presentation chart. These are my notes. This is how I keep track in real time of what's going on. And this is the 22 to 23 accumulation structure with all the Wyckoff labeling that I do. And I really kind of do this for me, but I just show it because it's a way for people to be able to, kind of document what I see going on. This is stocks above the 50-day moving average on the New York Stock Exchange, and which is really interesting. But look at how this number of stocks propping up the S&P just keeps doing that. And this is while the S&P has been marching higher, which I believe largely is related, as we all know, to the Mag 7
concentration. Yeah.
And
is that a? Do you know what are the conditions of a Hindenburg omen, Bruce?
Yeah, I just heard. I heard the definition last night, and
oh wow, how weird.
Yeah, but it's when you have a high degree of breadth on both sides, the positive side and the negative side, in sort of the way they calculate it. And you could go, I believe, even to stock charts and go to the school there and look it up. Okay. And probably anywhere on the internet. I'd be afraid to try to describe it, but it's an old indicator that they just normalized for the changes in advancers and decliners. And it shows still a market that's pushing higher, but there's all of a sudden a lot of destruction or deterioration underneath the surface at the same time. Right. And so it's sort of a market that's in conflict with itself. So, certainly I think you could see that taking place in this data here.
Yeah, and you show all the examples, couple examples of overbought and throw over, and that's where we are now.
Right. So so this chart here is as of a couple days ago, and you can see that there's an upward stride, which the market will often do, and in the Wyckoff world, you create a demand trend line and an overbought trend line, and it tends to bounce between those. It can go outside of them, and then an interesting thing happened here on this point and this point. You could draw a trend line that steepens, and so you can see the steepening, which goes back to right here where it confirmed itself in early 24. And so it actually steepened its advance. And this is the April low, but look at how it's marched up and gone right up to the overbought line of the steeper trend line and slightly through over right here, as it did here and here. Now I can try to live up on this trend line for a while, but look what happened subsequently. Not saying that it's got to do that again, but you can have some pretty good sell-offs off of this overbought condition, because this is the stride at which big sellers come in and decide to supply the market with stock. And so let me go to so here, this is an old point figure chart. Now this was as of November 23, and I believe I showed it here in the past, but this is the 2016 to 2020 accumulation structure. And look at how nicely it picked up that top that we got in 21 to 22 bull market peak. That's a distribution structure right here. And so there's a grand example of how point figure can be really helpful. And then now here's the accumulation that we've been in since 22, 23. And at the time when it was still unfolding, we were making the case, and that was what this chart that I just showed you, this chart, the vertical chart that I showed you a minute or two ago, was just an example of documenting that accumulation in real time. And so now look here, you can see, I'm just going to put all these up so you can see them and get through all these charts. But here, this count goes 6650 to 7,000. And we just hit 6920 on the 29th. And so now this chart only goes to November of 23. So you can see that it's come out of this area subsequently. And I'm going to update this chart for us. And so you can see it here. Now this chart on the left is a 30-minute chart, but the one on the right is longer term. But this is the I think it's the accumulation structure. Let me blow this up so we can see the data on it. I apologize. I'm on
it's okay.
Little computer today.
So it looks like you have a 7080 as a potential target up there.
So see, you can see here, this is that sell-off with the selling climax into the April low, and then from April to May, on a somewhat of a rising scale, it made a new count that we could take, and this goes 7060 to 7660, and as you just saw, we're pretty darn close. We could push up a little higher, and so this has been a very good near-term count in terms of being able to define how much fuel or potential there was in the S&P 500 here off that April low. And there's a little reaccumulation here. It also counts up to the same level and matches. We call this a stepping stone reaccumulation count. And when that happens, they usually get going and start to run again. So there's an example of, the market trying to push up into its final highs, and usually it'll do that with some kind of a climactic event. But this is the one that I think is so notable, Dale.
How about a reopening of the government?
There you go. That would be a perfect reason to get this market up into those objectives. Good news top, right?
Yeah. So before I interrupted you, where were you going on this chart?
Oh, so this is interesting because here's the NASDAQ 100, which is totally dominated. The S&P
Yeah.
is dominated too, but by the Mag 7.
Yeah.
And so you can see that the NASDAQ 100 also created a upward stride off its accumulation structure back in 22, 23. This is the bear market top in 21, 22. And I went back and looked at this chart, and I was showing, you and I were talking about this chart back then, back when it was just beginning to unfold. And so up it goes into this upward stride, which was a beautiful bull market, as we all know. But then what's interesting is look at this reaccumulation. It breaks down out of the stride where the S&P actually accelerated. So I find that so interesting is that this actually has the look of having slowing momentum on a long-term basis, which I think is fascinating considering the Mag
Concentration.
7.
Yeah.
Yeah. So let's go here. This is a point and figure chart of the triple Qs. And this chart you can see was from June of 23. And we had put this up at the time. I think we met a month or so after this chart, maybe at the same time, I don't know. And I had counted it in 3 segments. And when we had gotten to this point here, we were pretty much of the mind that we had a completing accumulation structure. And there was a lot of resistance to this. I got a lot of people that were just like, you're
very aggressive.
You're losing it. You're losing it.
Yeah.
So it's like, because remember, this interest rates were super high. Don't fight the Fed.
Yeah.
I mean, it was just a lot of negatives for the market. And me, I'm strictly a chart guy. Reasons are optional in my world. So
like
anyway, up it goes. And then we take these preliminary counts. This yellow count goes to around 420. These 2 counts together go to 532 to 564. And then we have this count, which is the whole accumulation structure. And that's how we do it. You just keep, you see the count, but you take it in segments because often these intermediate segments tell you where the market's going to stop for a while. Right. And then, so look at this, 636. And I'm thinking, how does Dale know to have me on when these things happen?
We're right there. Yeah.
And so here's where it went on the 29th, 637.01. This is 4-point scaling, so it's got to go to 640 before you can even put another entry in. So far, this count has been fulfilled perfectly, the upper count objective. And so let me just show you in the few minutes we have left. Let me just show you what this looks like on a updated point and figure. And so here you can see that this is the accumulation structure down here that we just looked at back in 22, 23. And here's the count. Now there's a little bit of a scaling change because this is a brand new chart I drew, but it's 1 box different. This is all it is. But this is through October 31st. Here's our count, 600 to 632, where you saw 636. I think it has to do with adjusting for dividends or something. Anyway, not important, not material. And
really outstanding. Yeah. Go ahead.
Yeah. So look here. Here's our distribution that occurred late 24 to 25, which ushered in the decline that gave us the April low.
Yeah.
In this count, 11 columns across gave us a count of 404. It's exactly where it went, 404.
It's freaky.
I know. It's
I still get chills. The hair on my arms still stand up when I see these technical areas fulfill, and so close.
Point and figure, which is very much a part of Richard D. Wyckoff's methodology, but it goes back 400 or 500 years.
Yeah.
Point figure charting is
All
just,
the floor guys, that's what they did. All the floor traders.
I used to
They,
go down on the floor and hang with them. They were, many of them were my
yeah,
friends, and they
yeah,
would stand there with these little trading card things. They were
yeah,
just grids for doing point figure charts, and they would
right.
do all the markets that they made markets in point by point figure through the day, and then they would take it back into the office and transfer it onto a big chart at night.
Yeah.
So you're absolutely right about that. And
They'd have gold coats, people that were runners or clerks keep I knew guys, they'd keep point and figure for the guys in the pit. And when they got a signal, they'd run over to the pit. They didn't have
fascinating.
like better communications, but they'd run over to tell their boss that,
Uh,
we have a reversal or a
I
breakout
love
or
that.
something. Yeah.
Yeah. And these charts are so special and they still work and nobody does them.
You
Nobody,
know
I
what?
mean, the floor guys do them, but it's like
Yeah,
nobody does these charts.
you're special. And you know why? We have Jim Valentine, who had a really, he talked about doing point figures, and people want to know how to follow you, have contact information. John Hawkins has been doing P&F for 40 years, so you have fans here. Where would you send your fans
Yeah,
to?
they can read a lot about how to construct point and figure and some nuances of it by just reading my blogs. I've done a
Okay,
couple of courses at Wyckoff Analytix with Ramon. They can do those. There's a fee there, but that's a complete course, soup to nuts. But
these
there's a
guys don't
lot.
care. They're rich. They'll pay. Uh,
Well,
but
anybody can go to the website, it's stock charts, and read my blogs. You'll have to like hunt around for them. But
okay,
uh, and then
that's
so
the best
here,
place. Go ahead.
yeah. So and then also there's some other free stuff. It's at Wyckoff Analytics. So just check it out. And then I also do a lot of demos on my TV show, Power Charting. So they can go look at those too.
Where's
Probably see
your
some.
where's your TV show on? Is that on stock charts too? Or
Well, I'm not. I'm currently not doing it. I'm doing another project for stock charts, and it's going to result in some kind of some video work. So
okay,
stay tuned.
okay.
I'm launching a new season of something. I'm working on it now.
Well, I hope it's not like ESPN, because I didn't have ESPN this weekend because I use YouTube to stream. And you know what?
Oh.
I've actually come up. You wait all year for the football season, then you can't see SEC games. Um, I have an acronym. The acronym for ESPN is Expensive Sports Pay Now. All right,
Oh,
that's
okay.
you
But
like that one?
I didn't. I don't have the expensive part down.
All right.
So a lot of my content, I want people to go out and use this stuff because
Yeah,
I don't think many people do it, and I think there's a huge edge in it.
yeah, there
So
is.
check it out. But let me just conclude here because I know we're done. But this accumulation in purple down here is the accumulation that took place off the April low and with that selling climax. And it's a rather wide, you can see it's a rather wide count structure, but it still counts, it still works. So what I do is I'll take the low count off the low and off the count line, and then I'll do the midpoint. But notice this count matches the
Yeah.
uh, accumulation count of 2223, which we just looked at. And we have just gone up and fulfilled that count here in the last few days. And just to conclude, look, this is equity call put ratio, and it shows lots of optimism. But what I really want to show is this is my friend who was a Wyckofian, Dick Arms, and
Oh, okay.
was a dear old friend. We miss him, but he did this thing called candle volume charts, which you can get and look at it, stock charts. But anyway, you can see when you get a run up like this and very high volume, very narrow range, that there's supply that is stopping the upward trend of the market. You can see when here this creates a sideways. Yeah. So this is supply coming in at the top of a trend. Look what just happened here. Yeah. So we have a push up attempt to test this very, very high volume, because that's the width of the bar is how much relative volume there is. So I believe that we could face either a range bound market or a reversal, and it's right into our point figure count objectives fulfilled after an accumulation structure in 2022-23. So here we are, we're thrown over, we're overbought, lots of positive sentiment, and we're getting our count structures fulfilled on multiple time frames.
Very important. Yeah.
Answer questions or whatever, but thank you for having me. It's always
very important interview that you did today, Bruce. And you know, and the timing kind of makes sense with the old Wall Street adage that the bears feast on Thanksgiving and the bulls on Christmas. So maybe we're going to have a little nasty sell-off into Thanksgiving this year.
Yeah, so I definitely think that, especially with that climactic surge we got in the last few weeks, and especially in the S&P and the NASDAQ, that has sort of a climactic quality, and climactic advances are often exhaustion of the trend.
Well, that gap it left last week when it gapped up Monday,
yes,
it hasn't been filled yet, but when it's filled, that's an exhaustion gap.
By the way, this chart
you don't have breakaway gaps after a 30-40% advance normally.
Right. And so there's
a gap.
This is a fun one to keep an eye on. I don't by any means recommend it, but I don't trade it. But this is MAGS, MAGS. This is the Magnificent ETF. 7 ETF.
Yeah.
And so what an interesting thing to look at. But all this volume coming in up here, I think is stopping volume. And so I think the best case is it just goes sideways, and as it has done in the past. And they do deserve to rest on the way up.
I think a 10-15% correction would be healthy.
Absolutely. And if we're doing that, we may be building the distributional structure now. We don't have that yet. We just for this program, we just fulfilled those counts on the upside, and Dale knew it. And he's like, I want to see these now.
Yeah, you picked the date because you wanted to take a little time, but I'll take it. There's nothing wrong with good luck of having an excellent technician around nearing what could be some type of turning point in the market, for people to at least have their eyes open and know that you never go broke taking profits.
Yeah, exactly. And survivorship bias.
Yeah.
You know, there's always going to be other opportunities. And so, you know, that's why we love listening to you, Dale, because you have that wisdom.
Well, from one survivor to another, Bruce, thank you, my trading warrior brother. Great interview. Everyone thank Bruce, and also go check him out. You can learn from a master. So a lot of the masters, like, unfortunately, like Bruce was talking about, their work is still here, but they are not here. So,
and we miss them every day.
Yeah. So, these guys from, I'll call it the best generation in trading, not like World War II. That was the best generation. But in trading, most of the guys are from the 60s and 70s that really were pioneers in technical analysis. So
couldn't agree more.
Yeah. So thank you, buddy.
Oh, thank you. It's always just so great to be with you all.
Yeah, it flew. We all enjoyed.
Well, look forward to seeing you again. I'll save this slide deck for the next time. We'll do some more of this.
All right, Bruce Fraser, everyone. Follow him on X at RD Wyckoff and follow his work on stockcharts.com and learn, grow and learn from Bruce's work.
Thank you
And
so
that
much.
and that's a wrap, everyone. Don't just count your Wyckoff formations, count your blessings, and we'll see everyone for Turnaround Tuesday. Adios.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.